Good morning. Today, I want to talk to you about a very important topic. At LRT, our investment strategy is to invest in companies with wide and growing moats, some kind of competitive advantage, businesses that can grow and reinvest capital at attractive rates of return, and have management teams that excel at capital allocation and can execute on those future growth opportunities. So with that, I really want to focus on the first part of our investment process, investing in companies with moats. Now, a business with a moat is fine and well, but if a business can't grow and reinvest within that moat, the moat doesn't create additional value for the company. Simply having a moat, high returns on capital on your current business, is often reflected in the business's earnings and cash flows. And you shouldn't be paying a premium valuation for the past. Investing is all about the future. So the question to ask is, can the business grow? Can it reinvest within that moat at high incremental rates of return? If it can't, there's no need to pay a premium for having a moat. And I think this is a widely misunderstood issue because I see many people today paying very high valuations, premiums to the overall market for businesses such as consumer staples, businesses such as Coca-Cola, Pepsi, Kellogg's, General Mills, Kraft-Heinz, Budweiser, and the list goes on. These are all businesses which do have legacy moats, but they don't have the opportunity to reinvest. When you look at most consumer staple businesses in the United States, they are not growing their top line revenues. Many of them have flat revenues for the last 5 years, which means that in real terms, after accounting for inflation, they're actually in decline. The only thing many of these businesses have is growing debts. So the question is, why would you invest in a business with growing debt, no reinvestment opportunities, and just a legacy moat? And there's no need and no reason to pay a premium valuation for that kind of business. A premium valuation should only be ascribed to companies that can reinvest capital at high incremental rates of return and do that successfully for many years to come. Coca-Cola today is not the same business that it was in the late 1980s when Warren Buffett was buying his stake there. So back then, Coca-Cola had massive opportunities to reinvest and grow internationally. You have to ask yourself why you're paying a high valuation for Coca-Cola today, given its future growth opportunities. And I'd love to talk to many of you about this issue because I see it as a pervasive issue in many people's portfolios. Many people have been convinced that these so-called wide moat businesses in consumer staples will protect them in the next economic downturn. And I think nothing could be further from the truth. Many investors are sitting on ticking time bombs in their portfolio because they have companies which are massively overvalued given their moats and given their very limited debt capacity and their very limited growth opportunities. So with that, I always look forward to your questions, especially talking about consumer staples and the big danger that I think so many people have in their portfolios.